Member Shelby, members of the committee. I appreciate the opportunity to testify about money market mutual funds and the continuing risks they pose to our financial system. As we all know, during the financial crisis, a single money market fund, known as the Reserve Primary Fund, broke the buck, triggering a run not only on that fund, but on funds across the market. Within a matter of days, investors had withdrawn about $300 billion from prime money market funds, or 14% of those funds' assets. It was one of several destabilizing events during the crisis. To meet their customers' redemption demands, money market funds began selling portfolio securities into markets that were already under stress, further depressing the value of those securities and creating a vicious cycle. Soon, other funds holding those same securities were struggling to meet the demands of their customers and found themselves at risk of breaking the buck. The shockwaves were widespread. Money market funds began hoarding cash and stopped rolling over existing positions in commercial paper and other debt issued by companies, financial institutions, and municipalities. This dramatically reduced the cash and liquidity available for those entities. In the final 2 weeks of September 2008, money market funds reduced their holdings of commercial paper alone by more than $200 billion. The runs on money market funds ended only after the Treasury Department took the unprecedented step of using the Exchange Stabilization Fund to guarantee more than $3 trillion in money market fund shares. While this step dramatically improved the market, it also put U.S. taxpayers directly at risk for money market fund losses. In the wake of the financial crisis, many have rightfully asked, where were the regulators and why didn't they do more to address systemic risks? Having reviewed this issue closely and methodically since my arrival in 2009, I've come to understand that money market funds pose such a risk, and others agree. Current and former regulators of both political parties have raised flags about the risks posed by money market funds and the need for reform, as has the Financial Stability Oversight Council. 2 years ago, we at the SEC passed a series of measures to increase the resiliency of money market funds by instituting liquidity standards, reducing maturities, and improving credit quality, all important reforms and one of the first significant responses to the financial crisis by any government regulator. But while these steps have been widely hailed, I said then and still believe that more needs to be done. That's because the incentive to run clearly remains. And since Congress specifically prohibited the use of the Exchange Stabilization Fund to again guarantee money market funds, this core part of our financial system is now operating without a net. There are several features about money market funds that can contribute to destabilizing runs. First, the stable $1 share price, together with a history of sponsor support, has fostered an expectation of safety. Based on a staff analysis since money market funds were first introduced, fund sponsors have stepped in with their own capital at least 300 times to absorb losses or protect their funds from falling below $1. When a sponsor does not or cannot support a fund, investors lose confidence and rush to redeem. Second, because an early redeeming shareholder can receive their full $1, investors have an incentive to redeem at the first sign of problems in a fund. Because large, sophisticated institutional investors are more likely to be closely monitoring investments and can move large sums of money very quickly, the slower-moving retail investors and small businesses will bear the full loss. And third, if too many investors redeem at the same time, the fund can be forced to sell securities at fire sale prices, causing the fund to break $1 and depressing the broader short-term credit market. This spreads the contagion to other funds. It is for these reasons that I asked the staff to explore a number of structural reforms, including two in particular that may be promising. The first option would require money market funds, like all other mutual funds, to simply set their share prices based on the market value of the fund's underlying assets. But understanding that the dollar is important to investors who use this product, a second option would be to allow money market funds to maintain a stable value as they do today, but require the funds to maintain a capital buffer to support the fund's stable values and to impose restrictions on redemptions. On many occasions, members of this committee have appropriately noted the importance of capital buffers. Here, a capital buffer would increase money market funds' ability to suffer losses without breaking the buck and would permit, for example, money market funds to sell some securities at a loss to meet redemptions during a crisis. If a large credit event occurred, the buffer could help manage the loss, and additional redemption restrictions or fees could slow the run, possibly supplement the capital, and dramatically reduce the contagion to other funds and the system. These ideas and others are the subject of continuing analysis and discussion at the Commission. Of course, if the Commission were to propose reforms, there would be an opportunity for public consideration and comment. That would trigger a meaningful and informed public debate on this critical issue for the nation's investors, taxpayers, and the financial system at large. It is essential we address this risk now rather than waiting until the middle of the next crisis. Thank you, and I am, of course, pleased to answer your questions.